stop scrolling for just 30 seconds. Because what I'm about to show you isn't another Bitcoin to the moon video. It's not a price prediction. It's not hopium dressed up in a suit. What I'm going to walk you through today is the most important structural shift in global finance happening. Right now, in March of 2026, and the overwhelming majority of people in this space have completely missed what it actually means. Wall Street isn't waiting for crypto anymore. Wall Street is rebuilding itself on crypto rails. And here's the thing that's going to keep you watching this entire video. Because I need you with me at least until the 8-minute mark. This shift didn't start with Bitcoin, but structurally it ends with Bitcoin. Because one regulatory shift that already happened, that most people glossed right over, has just unlocked the path to trillions of dollars in institutional capital. And almost nobody's explaining the full chain reaction of how it works. We are going to fix that today, right here, on the Wealth Continuum. If you're new here, welcome. This channel exists because I believe that understanding how money actually moves is the single greatest financial advantage any individual can have. If that resonates with you, consider subscribing. What we break down here, you genuinely won't find explained this clearly anywhere else. Let's start with what everyone watching this has probably felt over the past few months. You look at the macro picture. The long-term case for Bitcoin has never been stronger. You have ETF products from the world's largest asset managers. You have sovereign nations holding it. You have publicly traded companies treating it as a treasury reserve asset. And yet, what does the price do? Here in early 2026, Bitcoin has been trading in the $60,000 to $70,000 range. It's had a rough stretch. ETFs, which took in an extraordinary $21.4 billion in 2025, have actually seen nearly $4.5 billion in outflows just in the first 2 months of 2026. We just snapped a 5-week outflow streak this past week with over $1 billion returning in 3 days. But the broader picture? Choppy, sideways, testing people's patience. So what's going on? Is the bull case broken? Are institutions abandoning ship? Here's where most analysts get it completely wrong. They look at the price and they make a narrative. They say institutions are leaving. They say the cycle is dead. They say Bitcoin is done. But I want you to think about this differently. I want you to ask a better question. What if this consolidation isn't weakness, but preparation? Think about it this way. When a spring compresses, it's not breaking, it's storing energy. And the deeper the compression, the more explosive the release. Right now, the biggest, most sophisticated pools of capital in the world are not leaving crypto. They are waiting. And more specifically, they're finishing the work of building the rails that allow them to deploy at scale. And the most important part of that work, it just cleared a massive legal hurdle. Behind the scenes, institutions are not leaving, they're building, and what they have just been given permission to build will change everything. Let me show you exactly what that is. Now let me ask you something. When was the last time you thought of JPMorgan Chase as a crypto infrastructure company? Probably never. And fair enough. This is the same institution whose CEO once called Bitcoin a fraud. This is old Wall Street, old money, old guard. So why, right now, are JPMorgan, BlackRock, Franklin Templeton, Fidelity, UBS, Goldman Sachs, and the New York Stock Exchange itself all racing to build products on blockchain rails? Because they're not talking about speculation. They're not talking about retail traders chasing the next altcoin. They're talking about tokenization. And the reason they can now talk about it, and more importantly act on it, is because of something that happened in July of 2025 that most people in the space dismissed as political noise. The Genius Act was signed into law on July 18th, 2025. It became the first major federal legislation ever passed by the United States Congress specifically regulating digital assets. It established a comprehensive framework for payment stablecoins, legally defining them, requiring one-to-one reserves, removing them from SEC jurisdiction, and placing them under the Federal Reserve and the OCC. And now, in early 2026, the Clarity Act is moving through Congress. This is the broader market structure bill, the one that standardizes how digital assets are classified, regulated, and traded at the institutional level. The SEC, under its new chair, Paul Atkins, has already removed cryptocurrency from its special risk category. The regulatory fog is lifting. This isn't about crypto speculation anymore. This is about replacing core infrastructure of the global financial system and the firms that understood this first spent 2025 building. Now in 2026, they're deploying. All right, let's make this real. Before your eyes glaze over at the word tokenization, I promise you that in the next few minutes you will understand this better than 90% of people who work in traditional finance. Here's the simplest way to think about it. Right now, when a major institution wants to buy a treasury bond, settle a trade, or transfer ownership of a real-world asset, what happens? There's paperwork. There are clearinghouses. There are settlement windows that take 2 days, sometimes 3. It's a system built in the 1970s, and it still runs the global economy in 2026. Tokenization takes real-world assets, bonds, real estate, money market funds, private equity, even publicly traded stocks, and represents ownership of them as digital tokens on a blockchain. Instead of a paper certificate moving through 10 different hands, the asset itself moves. Instantly, programmatically, verifiably, globally. Let me give you 3 examples of what this looks like right now. Not in theory, not in pilot programs, but actually deployed. First, Treasury bonds. Right now, there are $8.7 billion in tokenized U.S. Treasuries sitting on chain. That's 45% of the $19.4 billion total in tokenized real-world assets as of today. BlackRock, Franklin Templeton, and Ondo Finance all have live tokenized Treasury products. Settlement in seconds. Yield distributed automatically by smart contract. No clearinghouse, no 2-day wait. Second, stocks. This is the new frontier. Coinbase launched tokenized stocks for U.S. investors at the end of 2025. Robinhood rolled out tokenized shares in Europe last summer. And just last month, the New York Stock Exchange, the NYSE, announced it is developing a platform for 24/7 blockchain-based trading and on-chain settlement of tokenized securities. Think about that. The New York Stock Exchange is putting its own market on a blockchain. Third, private credit. JPMorgan has already piloted the full life cycle of a tokenized private equity fund. Onboarding, transfer restrictions, reporting, and secondary liquidity, all on-chain. They're describing tokenization as the future standard for alternatives distribution. Not a future experiment, a future standard. BlackRock's COO, Rob Goldstein, called blockchain, and I want you to hear this clearly, the biggest financial breakthrough since double-entry bookkeeping. That's not a crypto podcast saying that. That's the chief operating officer of the world's largest asset manager. And Standard Chartered's CEO, Bill Winters, went even further, telling a conference that pretty much all transactions will eventually be settled on blockchain. His firm is forecasting $2 trillion in tokenized assets by 2028. The RWA tokenization market is already on track to exceed $100 billion in total value locked by the end of 2026. Instead of paperwork moving assets, assets move themselves, digitally, instantly, programmatically, and the financial system that emerges from this will look nothing like the one we live in today. Now I want to address the question you might be sitting with right now. If tokenization is so clearly superior, faster, cheaper, more efficient, more accessible, why is the market still choppy? Why isn't the price already reflecting all of this? The answer is one word, and it's a word you have heard 10,000 times in this space: regulation. But I need you to think about regulation very differently than you probably have been, because most people in crypto hear that word and immediately think restriction. Government interference, the enemy of decentralization. For institutional capital, for the pension funds, the sovereign wealth funds, the insurance companies, the university endowments that collectively manage hundreds of trillions of dollars, regulation doesn't mean restriction, it means permission. A pension fund manager cannot legally allocate client money to an asset class without clear regulatory treatment. It's not a preference, it's a fiduciary obligation. They are legally required to wait for clarity. And here is what's changed, genuinely changed, in the last 9 months. The Genius Act passed in July 2025. Stablecoins now have a federal legal framework in the United States. Banks are now legally permitted to act as crypto intermediaries. The SEC has removed crypto from its special risk category. The Clarity Act is advancing through Congress right now, expected to pass in 2026, which will standardize how all digital assets are classified. The EU's MICA framework is fully operational. Singapore, Hong Kong, and Dubai have each finalized their own tokenization regulatory environments. Every single one of these developments does the same thing. It expands the investable universe for digital assets. It converts waiting institutions into deploying institutions. More assets that can legally be tokenized means more blockchain infrastructure needed. More infrastructure means more institutional on-ramps. More on-ramps means more capital entering the ecosystem. And here is where I am going to show you something that most people, even people who follow this space obsessively, have not fully connected. This is where Bitcoin enters the picture unexpectedly, even though tokenization isn't about Bitcoin directly. Understanding this connection is what separates the investors who see cycles forming from the ones who react after they've already happened. This is the section I want you to focus on. And I want to be direct. This is not hype. This is structural logic. Ask yourself this. What happens when you put trillions of dollars of real-world assets onto blockchain rails? You need liquidity infrastructure to support those assets. You need stablecoins, dollar-denominated tokens that move freely across chains and settlement systems. You need programmable money that functions as collateral, payment, and margin across the entire ecosystem. Every dollar of tokenized assets that comes on-chain brings with it a structural demand for stablecoin liquidity. The Genius Act didn't just legalize stablecoins, it created the legal foundation for stablecoins to become the core plumbing of global finance. The total stablecoin market cap is already on track to surpass $300 billion. That number is going to look small in 3 years. Now, here's what stablecoin growth does to the broader crypto ecosystem. It floods it with capital. It deepens liquidity. It matures the infrastructure. It creates the kind of market that institutions can operate in at scale without moving prices against themselves. And in that deeper, more mature, more liquid, more institutionally integrated digital asset market, what is the asset that every major institution eventually gravitates toward as neutral, non-sovereign, hard cap supply collateral? Bitcoin. Think about it from first principles. If you're a global institution operating inside a tokenized financial ecosystem, and you need collateral that every counterparty universally recognizes, that collateral cannot be issued by any single government. It cannot be inflated away. It cannot be seized by policy. It needs to exist outside sovereign control. That is the exact property set that Bitcoin has. And as the financial system becomes more institutional, more globalized, more blockchain native, the property set becomes more valuable, not less. This isn't a direct cause and effect where tokenization goes up and Bitcoin price goes up tomorrow. This is a structural macro-level shift in what Bitcoin's role is, evolving from speculative asset to foundational institutional collateral, the kind of shift that plays out over years, not weeks. And before you dismiss that as wishful thinking, let me show you the exact historical precedent for what this looks like when it happens. Gold. When the global institutional financial system matured and needed a neutral reserve asset, gold became the foundation. Not because gold did anything new, because the system around it evolved in a way that made gold's specific properties uniquely indispensable. We may be watching the early stages of the same dynamic unfold with Bitcoin, but at internet speed, with global accessibility, and with mathematically verifiable scarcity instead of geological scarcity. Tokenization growth doesn't just benefit blockchain broadly, it quietly and structurally strengthens Bitcoin's position as the world's most credible neutral collateral. The mechanism is subtle, but the implication for patient investors who understand it is enormous. Now let me give you the historical pattern, because this has played out before in this exact industry. Let me take you back to January 2024. What happened when the first Bitcoin spot ETFs launched? The price reacted to the approval, then consolidated, and a lot of people said the narrative is over. The institutional story didn't play out, sell the news. But here's what actually happened. The structural change wasn't the announcement. The structural change was what the ETF product enabled. A legal, regulated, compliant institutional on-ramp for capital that previously had no way to access Bitcoin at all. And that capital didn't flood in overnight. It moved in slowly, systematically, quarter by quarter, as compliance processes were completed, as investment committees approved allocations, as wealth management platforms unlocked distribution. Wells Fargo, Bank of America, and Vanguard only fully opened Bitcoin ETF distribution to their client-facing advisors in 2026, 2 full years after launch. Those are tens of thousands of wealth advisors who are now distributing these products for the very first time. The structural change always comes before the price move, not with it, before it. Here's the longer historical example. When the first gold ETF launched in 2004, gold was trading around $400 an ounce. The ETF didn't trigger an immediate rally. What it did was create the infrastructure for a decade-long institutional accumulation cycle that eventually took gold above $1,600. The people who understood the structural change in 2004 and held through the noise captured that entire move. The people who watched the price in 2004 and said nothing happened at launch, the bull case is broken. They missed it entirely. So here's the question I want you to genuinely sit with. If the spot ETF was the structural change that defined Bitcoin's first institutional cycle, what is the structural change for the next one? My answer, the Genius Act, the Clarity Act, and the tokenization of the global financial system are that structural change. And we are in the middle of it right now, not at the end, not at the beginning, right in the middle, at exactly the moment when most retail investors are distracted by short-term price noise. The market often moves after the structural change, not before. The question is whether you understand the structural change while it's unfolding, or whether you understand it after the move has already happened. Now I want to give you both sides of this with genuine intellectual honesty, because this channel does not do one-sided hype. There are 2 scenarios that could unfold from here, and you need to understand both. In the first scenario, regulatory momentum continues. The Clarity Act passes in 2026 as expected. The SEC's innovation exemption gets finalized, allowing tokenized stocks and fractionalized real estate to launch without full traditional registration requirements. The OCC and Federal Reserve finalize their Genius Act implementation rules by July 2026. The institutional deployment that's been building begins moving from pilot to production scale. What does that world look like? RWA tokenization, TVL, surges toward the $100 billion target by year end. Stablecoin supply accelerates past 300 billion. Major wirehouses deepen their Bitcoin ETF distribution. Institutional capital that has been sitting in the waiting room, legally required to wait for clarity, gets the green light systematically across hundreds of institutions over 12 to 24 months. In this scenario, the structural bed of wood that has been quietly stacked for 2 years catches fire. And the price move that follows won't look like the cycles we've seen before, because the capital base underneath it will be structurally different. In the second scenario, macro conditions delay the deployment. The Federal Reserve keeps rates elevated longer than expected. Geopolitical uncertainty drives capital into traditional safe havens like gold, which, by the way, has already pulled in $16 billion in ETF inflows in just the past 3 months as institutions de-risk. The Clarity Act gets delayed. The sideways market continues. In this scenario, the thesis doesn't break. The timeline extends. The structural change is still happening. The infrastructure is still being built. But the price catalyst is delayed and retail patience continues to get tested. One signal, and I mean one specific signal, will tell you clearly which scenario is actually unfolding in real time. And it's not the signal most people are watching. This is the section where you get your real edge. Because most people watch price, and price is a lagging indicator. It tells you what already happened. I want to give you 3 leading indicators. 3 data points you can check right now, this week. That will tell you before the price moves which scenario is actively unfolding. Track these consistently. Not obsessively, but consistently. Signal 1, stablecoin supply trends. This is the single best real-time measure of capital that wants to enter the crypto ecosystem. When total stablecoin supply is growing steadily and consistently, and that means capital is positioning. It's building liquidity. It's getting ready to deploy. When supply contracts or stagnates, capital is leaving or completely frozen. With the Genius Act now implemented and stablecoins having legal clarity for the first time, watch how this number moves as institutional adoption of tokenized assets accelerates. If the $300 billion threshold breaks with momentum behind it, that is a material signal. Signal 2, Bitcoin ETF flow direction. We just saw over $1 billion return to Bitcoin ETFs in 3 days, snapping a 5-week outflow streak as of this week. The data is public and updated daily. What you want to watch is not a single week. You want sustained net positive flows over 2 or 3 consecutive weeks, especially when CME open interest is falling at the same time. Falling CME open interest alongside rising ETF inflows means the institutional buying is outright long exposure, not hedged basis trades. That's the signal of genuine directional conviction. Signal 3, institutional custody expansion announcements. This is the least talked about signal, and in my view, the most important one to track right now. When Goldman Sachs expands its GS-DAP tokenization platform, when a major bank announces a stablecoin issuance product, when a new institution files to launch a tokenized treasury fund. That infrastructure doesn't get built without a specific expected deployment in mind. Custody and infrastructure expansion is the canary in the coal mine for capital that hasn't shown up in price yet, but is coming. Price tells you what happened. Stablecoin supply trends, ETF flow direction, and custody expansion tell you what's about to happen. Watch the structure, not the noise. Let me close with something bigger, because I think this moment in financial history deserves a broader frame. Crypto started as a rebellion. It was born in 2008 in the wreckage of a financial crisis that the system itself created. A pseudonymous creator, a white paper, the radical idea that money could exist without permission from any central authority. For years, the financial establishment laughed at it, dismissed it, called it a fraud, called it a scam, called it a fad that would never survive contact with real institutional capital. And then something remarkable happened. They stopped laughing. Not because they were defeated, but because they realized if you can't beat it, build on top of it. And here we are in March of 2026. The New York Stock Exchange is putting its market on a blockchain. The world's largest asset managers are tokenizing the instruments of global capital. The United States government has, for the first time in history, passed federal legislation that legitimizes digital assets as the infrastructure of modern finance. Standard Chartered as CEO is telling conference rooms full of central bankers that pretty much all transactions will be tokenized. The rebellion didn't fail, it became the foundation. Crypto started as a challenge to Wall Street. Now Wall Street is rebuilding itself on crypto rails. And for the investors who understand this, not the ones reacting to weekly price swings, but the ones who see the structural change while it's happening, the opportunity in front of us is unlike anything this asset class has ever produced before. Not because of hype, not because of a cycle, because of what always happens when a new financial infrastructure layer gets built from the ground up. The assets native to that infrastructure become the most valuable in the epoch that follows. Now, I want to hear from you directly. Drop your answer in the comments right now. In this new tokenized financial world, do you think tokenization itself becomes the bigger investment story of the next 5 years? Or does Bitcoin ultimately capture the most value as the neutral collateral layer underneath all of it? Drop a T for tokenization or a B for Bitcoin. I read every single one of these, and I'm going to do a follow-up video responding to the most interesting arguments on both sides. And if this breakdown connected dots that weren't connected before, if it gave you a framework that actually helps you think about what is unfolding, please share it with one person who needs to see it, not to convince them of a price target, but to make sure they understand what's structurally happening before the price makes it obvious. That's what this channel is for. I'll see you in the next one. This is the Wealth Continuum.